Retirees spend years mapping out the exact costs of housing, groceries, and healthcare. But underneath those visible expenses, there is a quiet, continuous drain. Every year, thousands of dollars slip away through entirely avoidable overpayments. Careful people in their 60s and 70s continue paying bills they no longer owe. They assume that when they reach a certain age, institutions will automatically apply the discounts, exemptions, and freezes built into the law. That assumption powers what we can call the systemic default. Every local government, federal agency, and financial institution collecting those payments has a direct financial incentive to keep quiet. The financial machinery defaults to maximum extraction. The law might say you are legally exempt, but until you actively opt out, that exemption is worthless. The quietest extraction happens right on your federal tax return. Starting with the 2025 tax year, the law includes a temporary senior bonus deduction. Yet millions of seniors will continue overpaying out of pure habit. Take a look at this diagram showing how the new deduction actually works. The standard block represents what everyone gets, but the senior bonus adds a distinct $6,000 directly on top of it for every person 65 or older. For a married couple, that is $12,000 in extra deduction. People often assume their tax software will catch this automatically, or they mistakenly believe they have to itemize. When they fail to verify it, that money vanishes. A similar leak happens before your Social Security check even reaches your bank account. When filing for benefits, many retirees fill out a form called the W-4V to withhold federal tax from every monthly payment just to be safe. This sliding scale maps out the thresholds for provisional income, which determines whether your benefits are taxed at all. It shows that if your combined income stays below $25,000 for a single filer or $32,000 for a married couple, exactly 0% of your Social Security is taxable. Voluntarily withholding money on non-taxable income means you are letting the federal treasury hold your cash all year. You are providing the government a zero-interest loan. Stopping these phantom taxes requires pulling up your forms and actively adjusting your withholding. Trusting the government's default math guarantees you will leave money on the table. At the local level, counties quietly rely on a widespread misunderstanding about property taxes. Most homeowners assume senior tax relief is an income-based program for those struggling financially. This graph tracks home value against the actual tax burden under an age-based freeze. Using Texas as an example, once a homeowner turns 65, their school taxes are permanently capped. The rising line shows the home value doubling or tripling, but the tax line remains completely flat, regardless of the owner's income. County assessors never apply this freeze automatically, as every claimed exemption means lost county revenue. They enforce strict deadlines, waiting for the homeowner to realize they missed the window. The federal government uses a different tactic to extract overpayments on healthcare through Medicare surcharges, specifically the income-related monthly adjustment amount. Look at this timeline comparing your final working years to retirement. It shows a systemic lag. Medicare calculates your current premium surcharges by looking at your tax return from 2 years ago. The system ties your current premium to a high salary you are no longer earning. The only way to stop this retroactive penalty is to file Form SSA 44. Declaring retirement as a life-changing event forces Medicare to recalculate premiums using your current income. Relying on systemic defaults, whether waiting for the county to acknowledge your birthday or letting Medicare look backward, results in thousands of dollars in overcharges. Even the act of filing the paperwork comes with a built-in penalty. Every spring, millions pay storefront chains $200 to $500 to punch data from a standard retirement return into basic software. The IRS established the Tax Counseling for the Elderly program, and organizations like AARP provide free, certified tax preparation. These services are explicitly designed to handle standard retirement returns for everyone from the modest earner to the broad middle class. Stopping these basic administrative tolls is the first step. But for comfortable retirees who have built up significant assets, there are 3 specific, high-value maneuvers the system hides in plain sight. Retirees frequently stay in oversized homes, fearing a massive tax bill on the sale. The home sale exclusion allows a married couple to exclude up to $500,000 of pure profit from federal taxation entirely. Then there is the 0% capital gains bracket. A married couple keeping their taxable income under roughly $96,700 can sell appreciated stock and harvest those gains completely tax-free. This diagram traces the flow of funds in a qualified charitable distribution. It shows required minimum distributions moving directly from an IRA straight to a charity, completely bypassing the taxable income funnel. Because the money never registers as income, it lowers the taxation on everything else. Accumulating wealth does not shield you from systemic defaults. It simply increases the financial penalty for staying passive and letting the system run on autopilot. The tax code and local property laws offer explicit protection for seniors across every income bracket, but the execution of that law strictly requires you to stand up and demand the application of those rules. Being legally exempt is entirely meaningless if you wait in the dark for an automatic refund. No government agency is going to search you out to hand back money you surrendered voluntarily. The entire mechanism relies on a psychological trap. Lower-income seniors assume the meaningful deductions are reserved for the wealthy, while comfortable retirees assume relief programs are strictly for those who are struggling. Breaking that cycle requires abandoning those assumptions. By pulling your actual forms and systematically auditing your property tax limits, Medicare star charges, and tax withholdings, you close the blind spots. Financial security in retirement depends on both asset accumulation and the specific knowledge needed to stop the system from quietly taking those assets back.